Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at financial results, and of course, we're going to be focusing on the conglomerate sector, or one member of the conglomerate sector, as well as one member from the energy, non-trading sector, non-trading sector rather, but that would be very heavily energy focused, and we're talking about National Enterprises Limited, or NEL. Now, both groups would have reported differing results or differing fortunes for that recently concluded financial period. Let's take a look at how they would have performed and what investors could expect in the months ahead. Turning firstly to GraceKennedy Limited, or GKC, for their first fiscal quarter ended in March 2023. The group would have reported diluted earnings per share of just about 9.2 cents TT, equivalent, a 22% increase from the prior comparable period, in which they would have reported 7.6 cents per share. That is, of course, from March 2022. Revenue from products and services were up 7.6% from 1.5 billion TT equivalent to 1.6 billion TT equivalent. Overall, revenues increased 7.8% from 1.58 billion to 1.7 billion TT equivalent, with a net profit attributable to equity holders moving from 75.7 million in that first quarter of 2022 to that 92.7 in the first quarter recently concluded first quarter of 2023, a 22.4% increase. So certainly makes for tidy reading for GKC investors. From a profit before tax perspective, we can see that GKC would have had a fairly significant increase in its food trading segment, moving from 67 million in the prior comparable quarter to just over 102 million in profit before taxes. So that certainly is a fairly significant 52% improvement in profits in that particular segment. Traditionally, their largest segment, in fact. There was some decline in the banking and investment segment, declining from 20 million TT equivalent to just about 7 million, with the impact of non-recurring gains from that prior first quarter in 2022, of course, not recurring in the first quarter of 2023, as well as adverse financial markets, all weighing on the banking and investment segment. It was pretty much the status quo for money services and the insurance segments, which produced fairly consistent results with that prior comparable period in the first quarter of 2022 versus 2023. Now, in terms of margins, we can see that operating profit and profit before tax margins all improved for GKC. The operating profit margin did recover to 7.4% in that red column to the right of your screen, from 6.7% in the first quarter of 2022, and PBT, or profit before tax margins, also recovered to about 8%, just 7.9% from 6.3% in that prior comparable period. Of course, 2022 was characterized by significant inflationary pressures. Those pressures seem to be abating just a bit as we head into 2023, and that certainly has had some positive impact on GKC's operating and profit before tax margins as we head further and further into 2023. So perhaps a signal of what investors might expect in the coming months ahead for GKC in terms of its financial performance and results. From a valuation perspective, on a trailing earnings per share basis, or a trailing 12-month earnings per share basis, we can see that GKC has declined marginally to just about 32 cents TT equivalent per share, compared to 36 cents when we compare it to the prior comparable period of first quarter of 2022. However, with the more than proportionate fall in price of the stock, GKC stock, the valuation for GKC has fallen from a price earnings perspective from 16.6 times to just about 11 times, meaning on a dollar per earnings generated basis, it is in fact more attractive for would-be investors of the stock. So perhaps a good time to add to your position, or maybe take your first foray into owning GKC shares. Now, at a price of $3.50, again, as mentioned, GKC is trading at a price earnings ratio of 11 times, below the sector average of 18.6 times, and offers investors a dividend yield of 2.5%, slightly below the sector average of 3.1%. But keeping those relatively attractive valuations in mind, particularly from a PE ratio perspective, and with one eye on those improving margins, as well as continued acquisition activity, Bourse is maintaining its overweight rating on GKC for the time being. Turning very quickly to National Enterprises Limited, and for its 6-month period ended March 2023, and the group would have recorded an earnings per share figure of 75 cents, which is a 64% odd decrease from the $2.05 recorded in the prior comparable period. Now, Again, we're going to take that with a pinch of salt because from an operating basis, when we look at dividend income and operating expenses and overall operating profits, there was a fairly lofty 4,000% increase from the prior comparable period, of course, moving from 9.16 million in terms of operating profits in that prior comparable period of 2022 to 381 million in the most recently concluded period. The major change would have come in a reduction in fair value gains from investee companies, which is a very significant non-cash movement that would have been recorded, falling from just over 1.2 billion in fair value gains, again, a non-cash movement in the prior comparable period, to just about 69 million in the most recently concluded period. So overall profit or loss, well, profit for the period will have fallen from 1.2 billion to just about 447 million. Again, operating profits would have been up significantly. That non-cash movement of fair value gains from investee companies would have scaled back quite significantly in the most recently concluded period. Now, when we take a look at energy commodity markets, some key points to note with respect to natural gas liquids or NGLs, we can see there was a 20% odd decline in production in the domestic market from 3.1 million to just about 2.4 million barrels. And the price of natural gas liquids or NGLs on average, using a weighted average basket price, would have fallen just about 26% as well, from 165 to 121. For ammonia as well, we would have seen a 10% odd decline from 966 to 865 dollars per ton, as well as a very modest decline, just about 8% in terms of domestic production as well, falling from 2.4 to 2.2 million tons. That is for the period October to March 2023. Now, from a valuation perspective, NEL's book value per share has fallen just marginally from just about 0.2%, from $7.14 to $7.10. But using that market to book ratio, we can see that it is still trading at a fairly steep discount to the book value of its assets at just around 0.5 times, a very marginal increase from that 0.4 times in the prior comparable period. Of course, NEL's share price would have increased fairly significantly over those two periods, but its market value has been fairly resilient, although marginally declining over those two comparable periods. So at a price of $3.44, NEL is trading at that price earnings ratio of 1.7 times, and which is below the sector average of 42.5 times. But again, that may be a little bit inflated by some of the other members of this particular sector, and offers investors a dividend yield of 18% above the sector average of 6.2%. But bear in mind the cyclicality of NEL's businesses, which means that dividend yield could fluctuate in the coming periods. So with moderating energy commodity prices in mind, with one eye on that domestic energy production recovery, of which there is a fairly large question mark at this point in time, but with those relatively attractive valuations, Bourse is going to maintain an overweight rating on NEL for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com, and of course, you can check out our website at bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in the business section of the Trinidad and Tobago Guardian newspaper. That's it again for this week's edition. Stay safe, happy investing, and we'll see you next time on the Bourse Report.